Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to a special episode of InFocus, where we're going to talk about the recent market turmoil caused by probably the most recent announcements around tariffs from President Trump south of the border. Joining me is our Chief Investment Strategist, Joel Baker. Welcome, Joel.
Hi, Mike.
It's always good to have you on the show. Give us, another great voice of reason for us, especially during these turbulent times. Obviously, as Trump carries on with his program, the latest one, as I said, the Liberation Day, he's definitely sent equity markets into a tailspin, basically, and significant decline, as we've seen in the last couple of days. So maybe why don't we just start there, Joel? From your perspective, you've been around the block a few times, as we both have. Give us your perspective.
Yeah, that's a great introduction, Mike. So thanks. But yeah, you're spot on. Like last time we spoke, Mike, we talked about, one of the things that we were sort of doing at TriCert was expect the unexpected with Mr. Trump. You really had to sort of build that into the strategy, because we were just like clients or investors. You'd wake up and read the headlines and think, what happened last night? And this is a classic example of that. It's almost like, to your point, Mike, it's almost hard to keep up with all of the news and all of the headlines. So trying to build that into strategy, it just leads to uncertainty, and uncertainty just leads to market volatility. It is that simple. So yeah, we're seeing that every day. And, it's hard to almost see what is the market digesting as fake news as opposed to real news. Yeah, just to your point exactly. If anything, when we first started talking about, tariffs and Mr. Trump sort of getting strong-handed in that sort of a frame of mind, it's almost like the market set that aside and thought he was calling a bluff here. Like the market sort of kept going up and to the right, if you will, even though this was sort of bad news. And fast forward, as you said, we've seen a lot of market cap, if you will, disappear. And it's almost like these fake news sort of headlines aren't bluffs after all. He's serious about it. And all of a sudden in comes, fear, maybe panic into the markets. And here we are today with like I said, a lot of money lost in the markets in a very short period of time. So that's the reality of it. And that's what our clients are seeing and feeling and reading in the headlines. So it's very important for sure. No doubt about it. Again, to put this in context, I think this is very, very key. We always talked about the market almost maybe deserving a little bit of a pullback. You and I talked in our last podcast, the markets were getting a little bit frothy, a little bit expensive compared to,
right,
to longer term averages. So maybe one could argue a little bit of a pullback is warranted. We just didn't expect that all to happen within, call it, 2 trading days. And that's the reality of it is, we've seen almost correction sort of territory. Usually that takes months to happen, not 2 trading days. So that's exactly the magnitude of the volatility here. And so again, to put it in perspective, this might be something that we as market watchers see it every day, but investors might not see that, or clients might not realize it. Is it kind of puts us back to about Q3 numbers. So if you look at the market averages or the market indices, we're back to where we were in about the third quarter. So one could argue it's really just the pendulum swinging back a wee bit as far as that, especially when you consider the longer term, the bull markets we've been in, the strong markets we've been in. It's a little bit of a correction back in terms of that pendulum analogy. But the flip side is we've lost 2 quarters of growth in like I say, 48 hours or 2 days of trading. So that really puts it in perspective the other way too. So I just thought I'd sort of mention that in terms of the magnitude and what we're looking at here of an adjustment that we've seen.
Actually, it's good, because for sure you use use 2, good but negative words, fear and panic. When you see the drops, 1-day drops that we've seen. And, but first of all, thank you for putting in perspective in terms of what we've seen in the market for the last little while. And I think in terms of, as you say, we deal with the market every day. But for clients, when they get exposed to this and the fear and the panic, I always think it's always good to kind of go back to our first principles. And maybe you can give us some background in terms of when we sit down with clients and we build their portfolios and manage their portfolios, maybe give us especially during periods of uncertainty and volatility, what goes into our thinking when we're building those portfolios to help get clients through this?
Help guard against that. Yeah, that's a great question, Mike. That's one we get asked all the time, and it's certainly worth reiterating. So just to back up maybe 2 steps is the first sort of shoe to fall in this volatility, market that we're seeing here is really just those names that probably were getting a little bit rich in terms of valuation. So, basically the NASDAQ market comes to mind is a good one. Some of the technology stocks or the Mag 7, we were always talking about how they were getting a little bit frothy, that in terms of they were good quality names, no doubt about it, but did they warrant the premium that they were trading at? So names like, even in Canada here, Shopify comes to mind, a great company, but just trading at a high valuation. We typically didn't have a lot of exposure to that, or far less market exposure than what we were seeing in the S&P 500 and even in the Canadian index, simply because we were cheap. And so again, it just goes back to that valuations as, we kind of buy what we think is not only high quality names across, a bunch of different economic sectors, but we're kind of cheap in buying them too. So we don't want to pay those high valuations just simply to be in a name. So I think that definitely is step one, that we didn't really go out of our discipline in getting away from fundamentals in order just to chase stocks. So when I say about that first shoe to fall, that was really the first wave of volatility of those names coming back. The reality is now today, just given the timing of our call here, the day has kind of reversed here. The morning started to see a broader sell-off in some of the names like a Royal Bank and TD Bank and, those big broader industries, the banks, if you will, utilities, pipelines, not just the technology stocks. And that's a little bit more concerning, but I think that's this broader market. Like I say, this maybe panic selling. People are starting to sell off these other names. It could be some of the bigger products being sold, like i.e. the ETFs and the investment products where they sell down their portfolios. Could even be some program trading. Again, those sorts of things we won't know for, say, 30 days when we see sort of the results. But it just makes you wonder if that's sort of, what's going in some of the volatility today compared to last Thursday and Friday.
Right.
So layer that into the portfolios, because that's a great question that you've asked. How do we build the portfolios to sort of withstand this or play defense against this sort of a market mayhem? So first and foremost, it was we typically buy the quality companies, the companies that are going to, be there through thick and thin, should we go into a recession or not. Typically those kinds of companies do have stronger management teams that they have some levers to pull with regards to strategy kinds of things. So whether it be cost cutting or strategic items, even the markets that they're in, they do have some levers to pull there in terms of, sailing the ship through those turbulent waves. Another thing is we try to, build these sleep at night portfolios. Again, we talked about diversifying across a whole bunch of sectors, a whole bunch of different types of companies, even things like interest versus dividends, like all those kinds of considerations are built into the strategy as far as, diversifying the portfolios. Now, to put that in context, not to say that those names can't sell off like they are in sort of today's turmoil, but from a longer term perspective, those names sort of do provide a very sound sleep at night kind of defense strategy when you sort of look at the long term perspective of those kinds of companies, those kinds of investments. You hit on a good one too, the cash flow strategies. That's another thing we build in, Mike, as far as, a lot of the times clients are comforted knowing they have years worth of sort of withdrawals, whether that be RIF payments or systematic or regular withdrawals. The fact that those are well protected in the bond side of the portfolio is very, very comforting to clients. So even though the stock side of the portfolio can be up and down, you're sort of seeing the words of seesawing or teeter-tottering, whatever you want to call it. So we'd hate to have an environment where we're having to sell off equities at a down time in the market to fund those withdrawals. So the fact we've got a good sort of an isolation or an anchor, if you will, in terms of bonds or bond-like investments is very comforting to clients that we've built that into the strategy.
And I think that's really important that, especially when clients do rely on their investments, they're retired, for example, and living off of all their good hard work in their past, that they think they have, obviously they have the requirements, but again, we've constructed the portfolio to recognize that in the, call it the short to medium term, we have a set of assets that pays interest, hopefully continues to pay good dividends, and can fund those cash needs.
Exactly, Mike. And even put that into perspective, clients will probably notice in the portfolios we've been adding a lot of money to bonds in the last little while, and not that we expected this to happen. I don't want to paint a picture like that. It's not a case at all where we timed the market, but it was simply drifting. When we rebalanced the portfolio, the equity markets being strong, so that side of the portfolio had drifted upwards. The bond side, or the income producing side as we call it, has sort of drifted downwards. So it made sense from a, call it an equilibrium strategy to add to that weaker asset class or the smaller asset class and sort of, liberalize or balance out the different asset classes. So good news is we've been sort of adding to that, unbeknownst this was going to happen obviously today, but we've been sort of adding to that asset class just from a, valuations or a rebalancing perspective. And that's very, very key as well.
And I know as we talked through the last few episodes as well on the income producing side, we've also been adding government bonds as well. And
yep,
so,
correct. Yep.
Again, a little bit more stability, so to speak. So I'm a client. I'm sitting there looking at, and fear, panic. You're giving me some words of reassurance, but man, it's hard to look at the news. So, and not necessarily react. So talk again about, and this is something you and I talk about a lot, but the importance of a client staying on their strategy. Mm-hmm. Maybe just reinforce our thoughts on that.
Yeah, that's the key one, Mike. So moving forward, we can sort of talk about this, but moving forward, what do we do as clients? Like, you're hitting it spot on. So really two things come to mind I think we're sharing here today. And one is, we want to stick to that long-term strategy, Mike. As many of you know, and many listeners, as you know, I should say, that's the beauty of having a financial plan. It really is a key to a roadmap, your own sort of specific strategy. And I realize it's much easier said than done just to rely on the plan. I totally understand that. But really the key to that is it takes the emotions out of the picture. And it really sort of makes you sort of stay focused to that fundamentals, that strategy, that long-term perspective. And quite simply, it's, sticking to that sort of a strategy delivers long-term success. So in achieving all of the clients', goals and, financial objectives, that really is the key to keeping to that long-term strategy. I say that as opposed to making knee-jerk reactions to something that you might not be able to keep up with. That's what we were saying before about headlines being all over the map here. So definitely keeping to the plan is very, very key. Secondly, behind the scenes, I really think it's worth reiterating too that, we have a whole team, Mike, that are watching these sorts of things very, very closely. So whether that be, economic sectors or specific names or even strategic shifts that can go on behind the scenes as far as rebalancing, we don't want to simply just ride this out and do nothing. So again, we have a whole team sort of watching those sorts of things. We had been sort of expecting volatility and maybe some undeserving or undue sort of sectors. Last time we spoke, Mike, we talked about there'd even be some specific names that became volatile for no reason. So really, it's almost a case of where we're looking at the best high quality name that we can be in a market now. There might be some substitutions or maybe some buying opportunities of names that we haven't been able to be in for quite some time now. So that's being done behind the scenes as far as this rebalancing exercise or strategic considerations, whatever you want to call it. And that's very, very key to our portfolio management process, is just to sort of, build that into the fundamental perspective or the fundamental strategy as well. But to kind of put it in perspective, like, I feel like I'm not sort of, being a little bit realistic here, because it is very important, and we are seeing, markets behaving how we were sort of hoping they wouldn't. And really the one thing we have to sort of, touch base on, Mike, is last time you and I had our chat, we talked about an economic recession. Some of the economic indicators were sort of indicating that we weren't out of the woods yet. And I must admit, we were sort of in that camp, but we really weren't seeing that green light flashing as far as the stock market being strong. We sort of, we're watching sort of the indicators. We were watching sort of the valuation of the markets and kind of building our strategy around that. And so we really have to sort of watch this closely, that do the tariff sort of threats here or the tariff sort of, trade war consequences tip the scales now and lead into any sort of a global recession. And again, that's one thing that we have to sort of watch very closely, Mike. It's almost a case where it tips the scales from not only investors being concerned and panicking, but also to consumers being, potentially panicking and worrying. So obviously we'll keep a very, very close eye on that. But it really is an economic consideration here that we have to sort of watch over and above the markets. And I think that's very important for clients to realize that we are sort of watching that very closely. It's something very serious here we have to be on top of. And, let's face it, it couldn't turn into some sort of a global consideration here, not just a North American consideration. So
for sure. Sadly, it does look like that, right? In terms of a global, at least from a market's perspective. And as you say, the interconnected economy, for sure.
Mm-hmm. It really boils down to even growth rates, Mike. And this is getting into the weeds a little bit, but I'm sure some clients would like to hear that. When we look at valuations and growth rates, it's not only companies, but it's also economies. So it could be a case where, if there is a global sort of a threat here in terms of, actual trade wars happening, that could drill down right into to growth rates of not only companies, but countries. And so it's a different consideration, a different headache, if you will, but that's something that we have to kind of keep our eye on very, very closely as well.
And again, the comfort comes in as you described earlier in terms of the changes in the market, our quality, our disciplined approach, finding these holdings that can withstand the test of time. And also, there are opportunities, Lots of very esteemed investors in the past have commented that now's the time where there might be some great buying opportunities as well through these periods of volatility, where not all the behavior is as rational as perhaps it should be.
Yeah, and to sort of wrap that right back up to what we said at the first of our call here, Mike, to put it in context, it really is a case where the markets are still trading at average kind of multiples. Like, again, to kind of put it in context, we're really just back to Q3 sort of levels from dollars perspective or indice level perspective is maybe a better way to describe that. It's not a case where we've sold it off of lost 20 years worth of growth here. This is just a matter of months. So again, the markets really haven't, fared off as much as what people may think by reading the headlines and the fake news, but it is important. I want to make it very clear that we're watching it very, very closely. But I think it just helps put it in context here of where we're sitting in terms of the markets and the market multiples and the averages and the long-term, averages, things like that. So I think that's important.
Excellent. Joel, thanks for this.
You're welcome. Anytime, Mike.
Always calming advice. So much appreciated. Folks, it's at times like this that really underscores the value of a financial team. As Joel said, between your financial advisor works with you, pulls together your financial plan, your portfolio manager, your CPA. That team is here for you. We'd love it if it was always good news, but it's during these volatile times that, again, hopefully our value really comes shining through. Our approach is definitely grounded in discipline around diversified portfolios with quality holdings. If you have any questions, concerns, don't hesitate to reach out to your financial advisor, your TriCert portfolio manager, or don't hesitate to reach out to myself. Take care.